It's incredible what's going on with gold and such an important asset globally, and tells us so much about the health of the economy and health of all most of the imbalances that we currently have in the macro world. And this chart is only showing you that we are about 2 percentage points away from making new highs in gold prices. As you know very well, we've had a triple top recently. Technically, triple tops never hold, or I should say almost never hold. And we're likely going to see a breakout from gold here very soon. I mean, the economy continues to deteriorate significantly.
As gold prices linger near historic highs, Tavi Costa from Crescat Capital delves into the factors propelling gold toward a potential breakout, advocating for considering gold's role within investment strategies. Following the recent U.S. Federal Reserve's decision to maintain steady interest rates, gold prices increased. The breach of the crucial $2,000 per ounce level last week was attributed to investors' inclination toward bullion amid escalating tensions in the Middle East. Tavi highlights gold's historical outperformance, particularly against U.S. treasuries, especially in distinct gold cycles. He references the 70s when gold prices rose, even as bond prices fell and rates surged. After the Fed's announcement, there was a noticeable decline in Treasury yields, with the 2-year Treasury yield dropping below 5%. Tavi perceives a compelling case for gold to outperform a 5% yield on Treasuries in the current economic scenario. Citing concerns over heavily indebted countries consistently issuing Treasuries, Tavi posits that investing in a tangible asset like gold might offer a stronger case in comparison. Central bank demand remains a dominant force in the gold market, with their recent pace of purchases the strongest observed since the prior year, according to the latest World Gold Council report. However, traditional investment portfolios, commonly structured in a 60-40 allocation between equities and bonds, have yet to make a significant transition. Tavi suggests that ongoing issues and potential downsides in the bond market may prompt gold to hold a more substantial position within investment portfolios. This shift is anticipated to mark a crucial aspect, potentially leading to a new gold cycle. Before going to Tavi Costa's interview, thank you for subscribing to our channel.
We're now seeing the steepening of the yield curve after deeply inverted. We're starting to see, after earnings releases, some issues as well in the macro data of those companies. All that is sort of pointing to the direction that, what we call the trifecta of macro imbalances: the debt problem of the 40s, the inflation of the 70s, and the valuation problem of the 1990s. It really constrained policymakers, and it's time to be allocating capital towards hard assets. What a better hard asset than gold? And so, this is just to me, it's a setup for a wealth generation period for folks that are really able to shift their attention towards this industry that is likely to really do very well and perform well in this environment. So it's just basically the performance of gold relative to U.S. Treasuries. I believe we used this in our prior presentation. However, it's such a relevant data as well to be looking at and thinking about prior gold cycles and how gold really outperformed U.S. Treasuries in a very significant way, despite yields moving higher, which I think was a very contrarian view not too long ago. And a lot of, I would say, the largest argument against owning gold has always been, but it doesn't yield anything. Well, if your biggest argument is to own debt from another country that is largely indebted and issuing treasuries right and left, it's, I think there's a better case here for a hard asset like gold, that in fact, during that period you're looking at, that gold cycle, the first one in the 70s, gold was rising at about 40% annualized rate. And so, how does that compare with 5% interest rates right now? I do think there's a very strong case that gold will perform much better than a 5% yield on treasuries personally. So you can see here in the early 2000s as well, the gold cycle, which lasted about 10 years, where gold was very different market. We're talking more about China entering the WTO and becoming the manufacturing plant of the global economy. We've had a commodity bull market at that time. And so now, there's all sorts of triggers in this environment. Is the central banks accumulating gold, the 60-40 portfolios yet to remove that bond allocation towards gold, redeploy that capital. There's the production of gold is still declining across most of the major companies, the imbalances that I referred to, the trifecta. And so I think I don't think we've ever seen a time when there has been such a large amount of plethora of reasons to own the metal, and sentiment remains so bearish. And so this is shocking, right? Because gold is starting to make new highs. And you think about what's happening, there's traditional investment portfolios, and there's also central banks. They have different types of, I would say, goals when owning the metal. Central banks want to enhance the quality of their international reserves because they have a monetary system to anchor fiat currency towards in majority of times. Majority of the larger central banks have started to accumulate gold. We're yet to see this transition happen across most traditional investment portfolios that still own a large percentage of 60-40 allocations, where a majority goes to equities and bonds. As we see the bond market really continue to show some problems in terms of not only downside volatility and other issues, it is likely that gold will start becoming a larger percentage of those exposures. And so this chart it's quite remarkable to me, and an important aspect of why we're going to see probably a gold cycle.
If you think you're going to enter a gold cycle and silver is not going to lead the way to the upside, I think you're out of your mind. However, on Wednesday, silver experienced a minor retreat in the trading session, all while awaiting the Federal Reserve's decision. The total consumer debt has surged to a record high of $17.06 trillion in the second quarter of 2023, marking a substantial $2.9 trillion increase since the end of 2019. While this escalation doesn't immediately constitute an imminent crisis, it significantly impacts individuals engaging in loans or investments in the stock market. Tavi stresses the potential challenges arising from debt refinancing at higher rates, which could introduce severe obstacles in this economic landscape. He emphasizes the significance of allocating resources toward assets that exhibit the potential to perform well in such an economic climate. Let's get back to the interview.
We were talking about the reasons to own gold, and yet we're about to break out to new highs, and I believe we will, and so forth, and we start a new cycle for gold. And the sentiment is so bearish, but it's not just a sentiment. There's not just a divergence on sentiment and prices. There's also a divergence between prices of properties that have resources of gold relative to the gold price too. There's also another large divergence between gold prices and silver. If you think you're going to enter a gold cycle and silver is not going to also lead the way to the upside, I think you're out of your mind. I think that's going to happen. Yeah. And so to me, there are some things that have not yet changed, and we're seeing all these reasons right now where gold is very much in the very beginning of what I think would be probably the most important bull market for the metal since the break of the gold standard in 1971. Of charts that we have here, which is looking at gold versus euro, British pound, Chinese yuan, Australian dollars, Japanese yen, and also the Korean won. And the next one in line is gold in US dollars making new highs. And it's so important to see this debasement of global currencies that we're seeing. It's not only gold. I mean, all other hard assets are also, doing very well, performing really well in this environment. And to your point prior, I mean, in an inflationary era, an investor, in my view, needs to focus on two things. Obviously, there's a lot of other things you should focus on, but in terms of allocation and deploying capital into investments, you really need to think about hard assets, number one. Number two is looking for businesses that have pricing power. And it is so important to find why commodity businesses do well in inflationary periods. Well, because they have an inherent pricing power in their businesses. Their underlying commodity price of their businesses, which is hard assets, tend to do very well in those periods, and therefore they have pricing power. And so you tend to see an improvement of those fundamentals over time, along with metals, along with other commodities overall. So it is a very important part of how to really survive in this kind of inflationary era, which I think not necessarily inflation would be worse in the 70s or anything like that, but I think this is much worse of a problem than we saw back in the 70s. We didn't have the debt problem we have currently. The reason I think, Mike, that we haven't seen much more spilled over the economy in terms of this, if you think about how levered the global economy really is, and we're seeing signs of kind of the escape valves of markets like gold doing very well, and starting to break out in many different currencies as this chart proposes. But if you think about why we haven't seen further downside in the global economy, in my view, the main reason for that has been because we haven't seen most of those companies and individuals and sovereign institutions really start refinancing their debt. When they start refinancing their debt at much higher rates, it is sort of obvious that we're going to see interest payments across all those institutions to go severely higher, either relative to GDP, relative to their revenues, relative to their income. And that is when you start seeing the financial conditions really tighten and showing problems, which I think are going to be very stagflationary in their nature. And it's so important to have allocation towards the metal in that environment.
Spot gold was up 0.3% at $1,987.90 per ounce. Bullion prices more or less need to consolidate a bit before continuing to rise because the long-term view is still positive, said Carlo Alberto de Casa, market analyst at Kinesis Money. The Fed held rates steady on Wednesday, as widely expected, as policymakers struggled to determine whether financial conditions may be sufficiently tight to control inflation. How might the recent stabilizing of rates by the Federal Reserve impact the continued ascent of bullion prices? And what cues might suggest the trajectory for gold in the near future? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.